My name is Mark Estasen. I'm a partner at Aura Ventures. I joined the business over a year ago, and we are on a mission to empower the next 25 to 30 founders solving the world's problems one solution at a time. I've got a bit of an interesting background. I'm traditionally trained as a chartered accountant, but my founder curiosity started at an early age. I started my first company at 16, and since then I've scaled and exited various businesses across different verticals and different sectors. My journey as to how it brought me to Australia, as you can hear, I'm the token South African in amongst many Aussies. I did a short stint of investment banking in New York, working on a East Coast acquisition of a West Coast bank. I've run a hedge fund out of South Africa, and when I came to Australia, I was looking at the ecosystem and sort of investing on PA, and I came across my previous role, which was basically a very ambitious founder looking to disrupt the fresh supply chain sort of ecosystem. I designed the growth strategy and RPO strategy for that group and scaled it from an early stage business to business well north of 200 million, raised a whole heap of capital, and lived the founder scale up hat for a good part of 5 years. I stepped away from that business probably about 2 years ago. I promised my wife I wouldn't build another business with my second born on my way. But here we are 12 months forward, realized that it's safer to keep the wild animal in the wild than trying to put it back in the zoo. If you understand the pains that a founder goes through from early sort of in the early days, pre-100 days, pre-500 days, the risk curve can be mitigated from a founder if you have really good support structures that sit around you, and a core part of that support structure is the venture capitalist that empowers that vision. So if you think of like the AR stack, you've got different layers to the AR stack, and each part of that stack has its own relevance and importance. And a venture capitalist or an investor in an early stage business has almost the utmost importance because it gives them that sort of immediate jet fuel to continue to explore their solution and their thesis. Why I like that early curve is not only is it powering the next innovation curve for what the next 10, 15, 20 years looks like, but it's also very much a psychology game. And what I mean by that is that you're working with individuals that have a true conviction with how they're thinking about a problem, and they need someone to come on a journey with them. And capital can be capital, but it's actually strategic capital that sits behind that. And I feel like, given my broad base of experience, how I look at opportunities with sort of more of a technical layer, both from a product level as well as from a commercial level, being able to interpose myself at an early stage allows me to really unlock or try to help founders unlock the true sort of inherent value in that business and keep them from sort of falling off the wobbly parts of the road early on. So those first 500 days of any startup journey is critical, and that thinking style carries with them into later years. But if you can get really core DNA into the founder or founding team, I think it really sets itself up for success in later years. If I dial back 2 years ago, late 23 to 24, and I saw sort of some thematics coming out of the US and some of my sort of intel that I was acting on, I stepped back and I sort of soundboarded that against the Australian market and worked out through trusted hands, active participants in the venture capital space, in terms of what they were seeing, because there's a natural lag between the US and Australia in terms of thematics and what hits Australia. When I've got a very simple acronym that I live by, it's called DFI. D at the top for no dickheads, F in the middle that everyone has fun, and I at the bottom for integrity. And the reason why it's at the bottom is that if you don't have an integral bone, when you get to the really difficult decisions and the pointy end of conversations, they often fall on the wrong side on that equation. Historically, if I look back to some of the deals and the contracts that I've done, I've sometimes walked away from some of the best looking commercial deals because it's failed that key test for me. When we're backing founders at such an early stage, what we're actually doing is backing the individual, like understanding, can they wake up on the good days and the bad, and how do they navigate a constant wheel of decisions at rapid pace. So that integral barometer is very key in assessing the qualitative components. In terms of the seasonal change of thematics and ideas that are coming to market, Today, the way I assess it with founders proclaiming to be AI native is that, and they're pre-MVP or pre-product, it's like, well, you've got 48 hours to spin up a vibe-coded product. Put it in front of, there's no excuse for founders not to be putting up a would-be product in front of a customer to get really tight customer feedback. I think given the broad-based experience that I have, I've been able to look at both the commercial sort of strategic part of the business, but when I open up the bonnet and I look at your engine, I know what a spark plug looks like, and I know the technical components of product build because we've built so much product. So I think that blend in the early stages to demystify the sales component of what a founder does and should be doing. Everyone should be selling, and every founder should have a salesman or woman inside of them, because as you're building an early stage business, it's being able to identify those sort of sliding door moments in terms of opportunity, and having a clear articulation and vision as to how do you sort of seek out that opportunity, wherever it may come out. A lot of investors or participants in that journey completely underestimate the time that it takes. If you think about any business owner would appreciate that any sizable business isn't built over 3 years or 5 years. So it's sort of unreasonable for an investor to think that maturity profile should happen in a venture style business. The best businesses that have succeeded globally, regardless of venture, is ones that follow a consistent methodology to the way that they obsessively solve a problem, and the ones that obsessively solve a problem day in, day out are the ones that materially achieve great results. You can see some of the latest news flow between Eucalyptus, all the re-rates of the businesses that are coming through over the last sort of 7 to 10 years. Those positions are really becoming fruitful exercises for investors that backed them 7 to 10 years ago. In terms of a global positioning on my PA, I've been involved in multiple different businesses that have had very different exit profiles. And I think an analogy that I put to founders is that it's the baker analogy. So before you go bake a cake, you need to understand what the constituents need to be in the baked cake. You need to understand what your market is. Do you have more vanilla versus chocolate cakes? And ultimately, when do you need to sell the cake? I.e., you need to know your timing, you need to know your relevance. Are you trying to build a legacy style business, or are you trying to build an opportunistic sort of seasonal type business? Equally, as market dynamics change, you need to be reactive to know exactly when your time is to shine, to crystallize all your life's work, blood, sweat and tears into a transactional event. From Aura's point of view, when I was sitting on the outside of Aura and looking inwardly and assessing the opportunity to join the partnership, a lot of that assessment was going through the portfolio and actually trying to get a feel for what was the thesis and how they approached investment style. If I look at Catapult Sports and the way that they identified a niche positioning of that business, and it had its ups and downs in the way that it delivered its solution in market. But fast forward to where they are now, they were dogmatic and steadfast in the way that they obsessively went after the problem. And I think that often investors get caught up with the hype or seasonal change to thematics rather than sticking to what they know and what they're good at. And I think that looking inwardly to Aura, they've definitely been able to achieve that. And at the end of the day, your results have to stand up on their own 2 feet. They don't have a voice and they don't have a definition behind them. They are what they are. So the proof is in the pudding, I guess. As you've got more and more entrepreneurs more broadly across the globe, non-venture based, having material events, there's this massive succession wave and wealth transfer happening. The correlation and indexing is becoming heavily overweighted. So previously, when you were buying into the S&P 500, you were getting arguably 300 to 500 positions in businesses. But if you look at your correlation points in any listed instrument, you're getting heavily correlated returns to your MAG 7. So when individuals or advisors are looking to get some diversification in their business, they have to go contrarian in their view, and that the only way to do that is in a private market setting. The next issue is that the true currency debasement and monetary supply issues and aspects that are affecting public markets or general global markets is a function of the level of debt that's being put into the system. So as soon as that money printer goes off, and if you look at sort of the different monetary supply levels from like T3 to T0 to T3, arguably the S&P, when you normalize it, is basically just a function of your debt and money printer being on for as many years as it is. So if there's been, in very simple terms, 8% in elevation debt levels, is arguably 8% of the S&P growth. over that same period. How do you dislocate your return profile from the same sort of systemic risk? The only way to do that is in private markets. Also, with the emergence of more wealth creation, there is alternative ways to place investments into business, more so private businesses. Businesses are staying private for longer, and the single track to IPO to create liquidity events for investors, to create further funding mechanisms for businesses is slightly changing. And as this pool of capital, no different like self-managed super funds, it's not stopping, it's not slowing, and there needs to be alternative solutions or optionality for investors to take part of. Aura is very well placed because we have the lens and the landscape of all of our strategies from venture capital, private equity, multi-asset and real estate credit. Is we can see as those seasons change and the investor sentiment as it moves, and we can react, whereas sort of standalone strategists or investment strategists can't necessarily react as quickly because they're only driving a venture capital strategy or private equity strategy. So Aura is a business we invest from the very early inception of a business all the way through to well-established businesses, cross-market, cross-geographies, and with different thematic behind that investment strategy. When we sat down as a collective and we looked at like how do we reimagine the world of venture, and how do we see the world in the next 5 to 10 years, a lot of the key sort of messaging types or single words that stood out for us was access, democratization, and distribution. So if we think about those three words in isolation, how do we democratize? I think it's already happening itself, and that's because there's a massive demand function in the market for people seeking out non-wholesale investments, and a lot of people don't actually realize they qualify as a wholesale investor, but they're sitting behind a gatekeeper being an advisor or a license that dictates where they can place their cash. If you think about access, if we are trying to generally have a groundswell and lift the overall market, we need greater access and more available dollars going into an ecosystem, and that's like any market, how it matures. More dollars attracting to a marketplace, and with that there's more infrastructure that happens around it. If you dial it back to the gold rush, similar things happened. There's a gold repository that's found, people rush to a market, they're all sort of chasing the immediate hits of finding gold. Bars shape around it, community shape around it, infrastructure shapes around it, economy shape around it, and something very similar can play out with venture, with more capital support oscillating around an ecosystem through access. Really good things come from it. And then lastly, in terms of distribution, as investors, we know what we're good at, and we focus tirelessly on that. So by partnering with great partners that share in a similar vision with us and to us is critical to delivering on that mission statement for us. So VentureCrowd is passionate about providing access and distribution to a broader range of investors, and that sits perfectly in our sleeve of distribution. If I had to think about the one reason why we're partnering with VentureCrowd is that when, as a collective investment unit, we looked at the overall venture capital market and what we want to achieve on a 10-year view, what is our vision as Aura, three main bullet points or words come to mind. It's sort of democratization, access, and distribution. So when we look at VentureCrowd, they arguably tick a lot of that box for us, and we find it's a great platform for us to deliver that.
Oh my God, you're so tall.
That was. Do you want me to rehash all of that again?